So my name is Parsa, and this is Zeox Trade Channels. Uh, this is a YouTube channel for only trading. I'm going to be posting twice to three times a week, and I'm going to be posting about how we can trade options, how we can trade stocks, and hopefully you guys will learn something from these videos, and hopefully they can be helpful to you. So let's go straight to what we're going to cover today. So in this video, I'm going to talk about how we can do spreads. What are spreads, and why would you trade spreads instead of options? Well, me myself, when I scalp or when I trade for a short period of time, I just use naked calls or naked puts, right? But if I'm to, let's say, hold one position overnight, and if I'm trading on a small account, let's say a small account could be anywhere between $1,000 to $3,000 or even $5,000. And if you're using the same size account, I wouldn't recommend swinging options at all. Well, let's say if you're to swing any positions, any option positions for overnight, I would recommend, since you have a small account, especially if you're trading big names like Tesla or Amazon, which are expensive contracts or super expensive, and you might blow up your account let's say in one trade. So I would recommend you guys just use spreads, so it's a safer play, and you wouldn't lose all your capital at once, and also you can buy more time since they're cheaper. The downside is basically if you buy naked contracts, you would have the potential to make infinite amount of profit, right? But in spreads, you're capping your profit, but you're limiting your loss as well. Same as options, naked contracts and options. So you're limiting your loss, but you have infinite amount of profit. In spreads, you're limiting your loss even way more than what you're doing in naked calls or naked puts, naked options. But for spreads, you're also capping your profit as well. That's the return. That's basically the downside, because you're risking less money, right? That's how a stock market works. So the more you risk, the more profit you could get, right? So the platform I'm going to be using in this video is called Thinkorswim, which probably most of you traders are familiar with. And so when you go on Thinkorswim on Trade tab, or even if any other platform that you're using, just go on Options Chain or Options Trader. Even I use Interactive Brokerage sometimes, and I use the same thing. So I just go on Options Chain and use the strategy builder, and you can define your legs for your spreads, which I'm going to talk about and how they work. So basically, when you go on Thinkorswim, let's say went on Tesla. So here's Tesla contracts. So I went on 19 February. Since I'm swinging, I'm planning on, hypothetically, right? I'm planning on holding this position overnight. So I went on 19 February 2021. And so I'm going to go choose something out the money, right? So let's say if you want to buy the strike 1,000 for 19th of February, right? So that would cost you somewhere between around 6,100. So you have to risk 6,100 6,100 to just open this position. And basically, when you're opening a naked position in options, you're risking the entire amount of money that you're putting in, which is your deposit. So you have a potential loss of 6,000 or 6,100, somewhere in between. And in return, your profit is going to be infinite. So let's say if you get in the money, you'd be making around 4K, 5K, and that's a return you would get. But if you look at it, if you look at the risk to reward ratio, you're risking 6K to get 4 or 5K, right? Which is not even a 1-to-1 ratio. So in the first place, this is not a good trade. I wouldn't take on any trades that is less than 1 to 2. The ratio, the risk to reward ratio is less than 1 to 2. I wouldn't take it. So that's the first place. But let's assume, hypothetically, we're going to take on this position, right? So strike 1,000. I wouldn't want to risk 6K on my, let's say if I have like a $10,000 account, $10,000 account, I wouldn't want to risk like 60% of my account, right? So the better option would be if you go on for stocks like Tesla or Amazon, or even like for small stocks, like let's say for cheaper stocks like Apple, you can open a spread if you want to swing this position and risk less amount of capital, right? So let's say on Tesla on 19 February, right? We go on 1,000 and we choose instead of on this part spread, we choose instead of a spread single, we choose a spread vertical. That's the strategy we're doing. And now look for which one of these strikes, combination of strikes, have more, which one has more open interest and volume. So these are the open interest and volume, right? So open interest is basically the amount of people that are holding their position overnight, and volume is the amount of people that are trading that position within the same day, and they're going to close. They close their position before the market closes, right? So here we're potentially looking for more open interest, right? So if you go on here on this row, you'll see 1,000 and 1,010 strike has more open interest, 439 open interest. How much you'd be risking? It's somewhere between 165 to 355, around like if you click like somewhere in between in the spread of the bid and ask, you would probably have to pay like 250 or something. And so what you're paying is basically your deposit, same as naked calls or naked puts, right? That's the entire amount that you're risking. And your broker will tell you how much you'll be making in profit, how much is your cap profit as well, which I'm going to show you how we can find out about this. So in a spreads, we have two types of spreads. So we have debit spread and we have credit spread. So if you go, let's say if you predict the stock is going to go up, let's talk about debit spread first. So in debit spread, if let's say you predict the stock is going to go higher. So in order to open a debit spread, which means you buy a contract, you buy a spread, you open a position, you deposit some money, and then you get your profit in return if the stock goes in your favor. If the stock goes against you, you lose some of that deposit that you put in, right? That's how debit spreads work. Credit spreads are basically the other way around. So you choose the strike that you're predicting the stock is not going to approach to. So you're basically, the broker is going to give you the money when you open the position, and if the stock goes against you, the money is going to be deducted from your account, and then if it goes in your favor, you're going to keep the capital that you got in the first place. So now we're going to open a debit spread on Tesla. So I go here. Let me just move my screen to the top here so you can see. So I go here. I choose 1,000, 1,010. I click on ask or bid. And click on the ask. If you click on the bid, it's going to open a sell position, which you can change it either way anyway. So let's see how much you're risking. So you're basically, this is 10 contracts. So let's make it 1. So that's 1. So basically for one spread position here, you're risking $260. That's all it is. And in return, let's say if Tesla gets to 1,000 or above 1,000, somewhere in between 1,000 to 1,010, you'll be making $740 in return. My apology. So you'll be making $740, right? Now, when you want to open debit spreads, either in call side or put side, you can do the same for put side as well. It's exactly the same thing. You want to buy, let's say if you buy a call contract at a strike 1000, you want to sell one contract in order to limit your risk. And that selling position has to be a strike price further out the money than what you bought. So let's say if you bought a strike 1000, then you sell a strike 1010. So this way, if the stock goes down, like if it moves to the downside, then the position that you sold, the call position that you sold, that's gonna give you profit, and the call position that you bought basically is gonna make your position go negative. So this way they're gonna compensate each other, so you wouldn't lose as much as, let's say, if you just buy 1000 contracts. So if you would have just bought like as a naked call 1000 strike, you would have been risking like six grand, right? But here instead you're just risking $260 for just one position, and in return you're getting 760 profit. So back where we talked about, if you're buying, let's say if you were to buy this position naked call, you had a risk to reward ratio of 1 to 0.8, maybe 1 to 0.7 ish. But here you have a risk to reward ratio of 1 to almost 3. So you're basically getting the triple amount of what you're risking. So this is a good position, right? As long as we're predicting this Tesla is going to go up, which I don't think so, because this is just a personal opinion. Don't blame me on that if Tesla keeps going. Tesla is a weird stock, so it can keep running like to the moon, like for the entire amount of the stock market time, right? But let's assume like we're predicting Tesla is going to go to 1000. That's when we would have just opened this position, right? So yeah, this is about spreads. And as I said, if you want to do it like for on the put side, you would do the same. You just go on, let's say 700, 705. You're predicting Tesla is going to go down, and you just open a position here. All you're risking is $150. That's it. That's how you can do spreads. So now for credit spreads, are basically you're doing the other way around. So let's say we're predicting Tesla is not going to get to 1000 by the time these contracts expire. So the expiry date is basically when? Is 19th of February, right? So if we're predicting Tesla is not going to get to these strikes, then instead of just buying a call and selling one further strike, we do it the other way. We do it. We need to do the exact opposite, right? So we sell one. We sell the 1000 strike and we buy 1010, right? So that's for credit spread, and that's when you're predicting the stock is not going to approach these prices. We can do the same thing as we talked about in put side as well, right? So that's when you predict the stock is gonna. If you want to open a credit spread on the put side, that means you're predicting Tesla is going to keep going higher. So it's not going to get to, let's say, 740, 745. So you open a credit spread on this position here. That's how you can do spreads. So to recap this video, basically what we said is we don't need to, So basically what we said is we don't need to risk a huge amount of capital or huge amount of like our account size, especially if we have a small account. We just need to, we can open spreads instead. We're lowering our risk, and then instead we're capping our profit as well, which is fine. We can get a decent amount of profit for risking less amount of capital that we have in our account. So why would you risk 6K instead of like $260, you know? So that's how we can do spreads. I hope you guys like this video. Hopefully in the upcoming videos I'll improve everything. I'll improve all the shortcomings if we had any in this video. And comment down below if you have any questions or if you have any recommendations or suggestions that I can improve on the next video. And make sure you subscribe. This is the subscribe button down here. And hopefully I'll see you guys in the next video. Peace.